I'm now joined by the man responsible for Barcap's U.S. economic outlook. Michael Gapen is live for us in New York. Michael, thank you so much for joining us on the show. First of all, if the vote does get through, would you be disappointed by the fact that it was such a weak compromise?
Well, no, I think we would be satisfied that we got past the debt ceiling, right? So the major problem right now is not that resolution of this provides a boost by any means. It's that you're avoiding a bad. So it's not so much what number was attached to it. Our view is you just needed to get beyond the debt ceiling, and that any agreement that allowed the debt ceiling to be increased would not address the medium-term fiscal problem. So it's a start in that direction, but not enough to placate markets or the rating agencies.
And at this point, we don't even know if the vote actually will go through, Michael. When you say it's not great, but at least it avoids the bad, what happens if we don't get a vote, or you know, what happens if we don't get an agreement by tomorrow night?
Well, that's certainly something that would upset markets dramatically. It would put the specter of a looming default and downgrade back on the table again. Certainly markets were very unsettled in the last weeks as we approached the debt ceiling. As your previous commentator mentioned, we do think it'll pass, but we do think the vote will be close. It's a largely manufactured crisis, so we can't put anything off the table at this point, but we do think it'll pass.
All right. Now, as you said, it's unclear whether, you know, even if we get a vote, it will be enough for the credit rating agencies not to downgrade the U.S. What happens if we do get a downgrade? Are we talking about a major sell-off in equity markets, but also in bond markets across the globe?
We don't think so. We think markets would largely be able to handle this type of event. So we might see some issues in short-term funding markets. As you know, Treasury bills and bonds act as collateral in those markets. We think you'd see an increase in debt financing costs in the U.S., maybe somewhere around the order of 25 basis points or so. We think longer term, rather than the hit to, say, Treasury yields or economic impact, what you might see as a greater impact from a downgrade is the effect on the dollar status as a world reserve currency. So a AA rating on U.S. Treasury bonds may not be commensurate with the significant role that the dollar plays as the world's reserve currency. So what you'd likely see is a reallocation of foreign central banks away from the dollar, which would gradually weaken the dollar over time.
Yeah, but what would they be buying? Because we've heard noises from China saying, well, we're not too happy about what's happening. But at the end of the day, they're probably going to stop buying dollar or, you know, to change the reserves. But they can't sell it, can they?
Well, that's right, and that's in the end why we say that the broader economic and financial market impact of a downgrade is likely to be limited. There are not many other good alternatives at this point in time. There will be some impact to it, and there will be ongoing pressure for the U.S. to get its fiscal house in order. And a grander agreement, one that gets somewhere around $4 to $4.5 trillion, is something we think that would get everybody back in line and would get the rating agencies and the market on board.
Michael, it doesn't seem to be priced in. This is what maybe worries me and what I don't really understand. Why are markets not really pricing in a downgrade? Sure, they're going for safer assets such as gold and also the Swiss franc, but they're not pricing a downgrade, are they?
Well, there's several sides to this debate, right? And what gets priced in not only is the effect of the downgrade, but also the economic impact. So what the market sees is a downgrade could mean higher yields. That's a negative for growth. Or if we say we don't, if in order to get the rating agencies happy and avoid a downgrade, we need a larger cut in fiscal expenditures or an increase in revenues. Those are likely to be a drag on growth in the near term. So on one hand, you have lower growth prospects pulling yields down. Maybe that's offset to some degree by higher yields from the threat of a downgrade. Those are both working in opposite directions at this point.
All right, Michael, thank you so much. Michael Gapen there.